Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Yeah, do you know the myths, the legends have it that the term yield, right? When we go to the bank, we expect to get a yield. Maybe people don't expect that anymore because zero for so long, but right, you get yield. Well, apparently the term yield came from farming and from growing crops, the growing of crops, right? If you plant an apple tree, you wait some period of time and then it gives you yield every year, right? You did the work and now you get return for your effort. You get apples every year. Plants, produce, things like this. And so it's interesting how our world has changed, right? It was you had a lot of kids because you needed people to help you on the farm to grow. And then we moved to factories, and then we moved to cities, and now we moved to offices, and now we moved from offices to working at home on your computer, right? And it's continued to change. And then the things we need have changed along the way. Like now when you're living in cities, kids are not as beneficial because like it's expensive to live in the city and there's not room for them to play and things like this. So it's crazy how that's changed. But the fact that the point is that term has come from a very interesting place. And then it went to you would give the blacksmith your gold to hold in his vault to keep it safe. And then the blacksmith realized he could lend that out to people. And this is how the whole thing started. So he'd give you yield so he could lend that gold out to other people. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Welcome for another edition. This week's topic is buy high, sell higher. And we've got a great show lined up for you today. And, you know, we have this show because people don't know what people don't know. And so many times there's a lot of noise out there, and we're trying to filter that noise for those who are in and close to retirement. So welcome aboard to our show today. Daniel, that is stinking interesting. History can be so interesting. And, I am a believer that history tends more often than not to repeat itself. And certainly you're not talking about history repeating itself, but you're talking about history and how things came about and the origins, right? Definitions. We're big believers in making sure that when we're talking about things and using words, that we use the definition that the person we're speaking to understands the definition, so that we're on the same page. Because that's how seniors get taken advantage of, because people use the same words but use different definitions and don't tell the seniors doing that. So, wow, that is really interesting. I think still on the bank statements it says, even if you get like 0.10, 0.01 or whatever, it says yield 0.01, so that's a great thing. You plant an apple tree, you get how many apples did you yield this year? Right. I got 100 per apple tree or whatever. Right. So that's great.
The return on your investment. Right. And yield is an important thing. Now, I think people have kind of forgotten about yield.
Definitely.
Because it's been kind of non-existent unless you were like really specialist and you know how to find some of these deals. But we've gone to a mentality, what would you say, since 2013 to 2016, from yield, from collecting. I mean, maybe the yield part was gone, but this is an important part of a retiree's stress-free retirement, is to have a yield that you can count on, just like you can count on the apples to grow everywhere once you've done the work to have that apple tree. I'm going to buy these stocks, even though they're high, because what I've been trained to do is watch them go higher. And this can only go on for so long. You and I were talking a little earlier, right, about the tulip bubble. And back in Amsterdam, right, the tulip bubble, where it started out with these colorful tulips and people would trade them. And the inherent value was that they were beautiful.
Yeah.
And that was it. So they were dried tulip bulbs and they would trade them, and it got traded higher and higher and higher and higher and higher. And the legend has it that eventually there was people trading mansions on the canal for a tulip bulb.
For one tulip bulb.
And that's kind of the idea of it was working until it
Yeah.
didn't work, right?
Right.
Because the value was already gone. It was just, this is a fun trading thing. We're trading, and they forgot about the yield. They forgot about pay me. I'm going to trade higher and higher and higher, and it turned into a gamble until eventually it all went away, and the person holding the bag at the end lost everything.
Like a game of musical chairs, huh, Daniel?
Yeah.
Yeah. So I take it that, so that's the idea of today's show, right? Buying higher and higher and higher. That eventually the bottom fall out or can fall out. And you've got some things I know that you want to share with the audience today, but you're listening to Financial Strategies with Andrew. And let's try it again. Andrew and Daniel Agemy, this father and son team, trying to bring you and help you to know what you don't know. Today's topic is buy high, sell higher. And today we have a paper available to you that we put together to be able to help you understanding these things. And it's called Understanding Price to Earning Ratios. And that's how we can say what we're saying because of what these ratios are. And this is a simple paper. It's only 3-4 pages. Actually, it's 2 pages. It will give you some documentation, some information for how you can discern for yourself and understand that what we're saying is true. So we'd love to put this in your hand. Just call us at 800-725-7616 for your free copy. No obligation, 800-725-7616. Understanding Price to Earning Ratios will help you to understand how buy high, sell higher is really a fallacy. Daniel, this is, things are crazy right now. It's much like that tulip mania that you were talking about, where it doesn't matter what the inherent value of that tulip bulb was worth. It is selling for more than what it's worth. And it keeps selling because there's somebody else that will buy it. And, we saw that happen because the stock market came down 20% and people stopped buying and there were more sellers than buyers, but then people started buying again. And they're buying because they're buying high with all inherent, as far as the numbers go and everything. But they're betting on if they buy it high that they'll be able to sell it for higher. They're counting on that, right?
Right. And why do they do that? Well, it's partly because that's what's worked. It's partly because a lot of the financial-ese, the financial organizations, the advisors, the news outlets are kind of saying, well, this is what we do. Yep. And it's interesting because when we look at ratios, right, there's a lot of different ratios we could evaluate where the stock market is. And when I'm talking about stocks, I'm talking about U.S. stocks particularly, because I see a lot of value in some non-U.S. markets and some other types of investments that pay you. But we're just talking about general stocks, U.S. stocks. And people say, well, they've come down, right? They're down, 20% from their highs. They must be a good deal. But they're still historically high, ultra high levels. Yeah. And do you want to buy something when it's cheap or high, right? Like if you're buying a Lexus and, it's been selling for 60% over its normal value, its retail value, and it comes down so it's only, 45% over. Are you like, wow, I'm getting a great deal? Or are you still saying I'm overpaying for this thing?
Oh, yeah. It's terrible what's going on. People have been conditioned to do exactly that. Buy it because it's going to go higher. And it becomes like a mentality that it's just an automatic. It's going to be worth more. And so now where the market is down give or take 15%, the stock market, people think, well, should I be getting out or not? Which direction is going to go. The whole idea about investing is buy low, sell high. And that's what Wall Street does and gas stations do and restaurants do. That's what business is about, buying low, selling it for more. But what's happening in Wall Street right now with the stocks is they're being bought high and selling for high. The whole thing about, and investing is easy, right? From one standpoint, it's simple, but it's not easy. It's the simple philosophy, which is buy low, sell high. But the question is, when is low and when is high? And unfortunately, most people, most investors buy high and sell low. That's the problem. That's what we're trying to refer to today. So anyway, time is really, we're moving along here. It's time for us to be able to take a break. And before we do, we want you to understand that you're listening to Financial Strategy. Oh man, my tongue is really messed up today, Daniel. Financial Strategies with Andrew and Daniel Agemy. Today's topic is buy high, sell higher. And we have a book that we'd love to put in your hand that will help you and educate you. We're all about education. We believe education is very valuable. And if you think it's too costly, we'll try ignorance, right? And so anyway, with book Financial Insanity by our friend David Scranton, it's a very, very easy read book, little over 100 pages. If you're a slow reader, you can read it cover to cover in 3 hours, and it's going to give you a lot of information about what's going on in the world today. In the market is financial. It's insanity from a financial perspective. Would love to put this in your hand. Please call 800-725-7616 for your free copy. The first five first-time callers at 800-725-7616 get a free copy of Financial Insanity. Call now.
This is Financial Strategy with Andrew and Daniel Agemy.
So, Daniel, you know that I don't like to play games with in general, but especially with your sister, Andrea, and your mother, right? If one of them is in the game, I know I'm going to lose the game. I've been conditioned to know that if one of those ladies are playing a game with me, I am not going to win the game. Now, I play the games because I want to keep them happy, right? Because if mama's not happy, nobody's happy. But I've become conditioned to that fact. And that same thing with sports, because when I played sports growing up, I was always on losing teams. And I began to take on an attitude that I could not win and my team would not win. And so I kind of gave up on sports from that standpoint. That's not my forte. I'm more of a mechanical guy and financial guy and spiritual guy, right? So I focus on my strengths. But I first learned about conditioning in college, Daniel. I think it was psych class. And I remember how they taught me about conditioning, reading a story about they had a fish that was in a tank. And they put a piece of glass between it and then put a bunch of minnows in that tank. And the minnows would be swimming around and the fish would go up against that glass, hit that glass, hit that glass, hit that glass, and could not get those minnows to eat those minnows. And pretty soon, the fish stopped trying. And they took the glass out from the thing. And pretty soon the minnows start swimming all around that fish right in front of its mouth. And he wouldn't try because he was conditioned to think he couldn't eat the fish. And I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today we're talking about buying high and selling higher. And how does that fish minnows conditioning story have to do with what we're talking about today about,
well, yeah, because
that's selling higher.
That's exactly what's happened, Daniel, is people are buying high and selling higher because they've been conditioned that the one of the lies of Wall Street, well, I shouldn't say that. One of the aspects of Wall Street that needs to be explained is that the market always goes up. Right. And over a 50 or 70-year period, yes, the market goes up. But the question is, does it go up when they need it to go up, right? And so people are saying, oh, if I buy this today, it will be worth more tomorrow, right? And that happens. Like, well, let's, it's kind of interesting, right? Because my son, your brother, told me that he sold a car yesterday that he bought brand new, put 15,000 miles on it, and sold it for how much he bought it for. And he bought it high because it was expensive car, many tens of thousands of dollars, and he sold it for what he bought it for. Amazing thing that hasn't happened in the past, right? In the past, you buy a car and then it loses. You take it off, you try to sell it later, and you have to sell it for less than what you bought it for. This is an uncanny market and time frame that we are in, that you can buy something and it would become worth, and it's worth more next year. That can't go on forever. People have been conditioned, is the point, that this is going to happen. But, and because of that, they think that it's always going to happen. And when the people think that way, they think the risk factor in their mind comes down, and the risk goes away, but it's in their mind, but the risk is still there. And so people are being conditioned and have been conditioned to do this. And one of the problems with this is, one of the things what keeps it going higher, Daniel, right? And is people putting money in their 401ks. Because you have a ton of people put in a ton of money into 401ks, and they've got to put the money into where? Into the stock market, because they're typically not given any options, or very many or very good options other than the stock market. So they put in the stock market. So now the funds that are getting this money have to buy, even if they don't want to buy, even if they're not good deals like you're talking about in the earlier section of our program, right? They have to buy. And so then it drives it up. But that's not to say it's always going to be going from that standpoint. We're going to talk about some things when we talk about GDP and some of those other things that we talked about in preparation for today, but it's just crazy. So that's what, where we're going with this thing.
Yeah, absolutely. And this is something that sometimes gets put on autopilot. And when you're talking about those passive flows, that's a huge thing that you can spend hours and hours going down that rabbit hole of passive flows, and what ETFs and mutual funds have done, where money is going into overvalued companies by every metric because it has to, just like you said, because that's the way the flows are. And then when things go up, they attract more money, just like the tulip bulb mania we talked about. Now, I'm not comparing the U.S. stocks to the tulip mania. I guess I am, but I'm not saying it's that outrageous as the tulip mania, but it's overvalued, and people aren't looking at the value of these stocks anymore. What they're doing is they're saying, okay, you talked about 401ks. That's what's called dumb money. No one's saying, what are these values are? It just automatically goes into index funds. Right. And then foreign investment has come here as well, because U.S. stock markets, the same thing happened in Japan in the 80s when all money went into Japan. And that lasted until it didn't. So we want to help people understand what's going on so that they can make an educated decision. We're not doomsdayers. We're not saying anything about that. But what we're trying to do is protect retirees' retirements. And help them understand that there's better ways. Just because it's worked for the last 13 years or so doesn't mean that that's going to continue on, where you can buy something high and say, this will keep going higher.
Right. Oh, Daniel, that's so true. Man, I'm right there with you. Listen, if you just joined us or whatever, we want to let you know you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. When it comes to retirement, we want you to be able to retire and stay retired. We want you to have a stress-free retirement so you can enjoy it and not have to just sit on the couch. So we're trying to educate you through our show, as well as giving you various things that you can use to be able to educate yourself. Today, we have a paper that we put together called Understanding Price to Earning Ratios. So this is, there's certain ratios and certain equations and things associated with the stock market and with investing that can help you recognize what to be doing and when's a good time. And you don't need to know all the ins and outs, but you need to have a clue as to what's going on. And we give you this paper. It's only about a page and a half long, and it's going to be able to help you understand and have clarity, or at least know what questions you should ask. All right. So, and we'd be glad to field those questions. And you're free to, email us or to call us with any of your questions so we can make sure that we answer those on the air and that kind of thing. So listen, if you want this paper, Understanding Price to Earning Ratios, call us 800-725-7616 for your free, no obligation paper, 800-725-7616. So Daniel, you're talking about these different things, and the thing that comes to my mind is a game of musical chairs, which we've all played, especially as kids, right? And you go around and around and around, and music stops, and the guy, somebody is left without a chair. And right now, the market's come down a little bit, but we have some options ahead of us that could mean that more people are without chairs, depending upon what happens. And it's okay for a young person to be without a chair because they can stand up with no problem. But older folks need to be able to sit down. They need a chair. So, if you're in or close to retirement, it's important that you have a chair when the music stops. That's important.
Yeah, exactly. And, you had mentioned a few times today how history tends to repeat itself more often than not. And I'm a huge believer in history repeating itself, all the way to the fact that it's like every 80 to 90 years, we kind of repeat the same patterns because we have books and we have internet and we have these things, but the whys are gone. And then we repeat the same mistakes that the last 100 years, the last 90 years have, and it just keeps repeating the same 90 years over and over, different technologies, different things. But I think this is exactly what happens, right? Once your great grandfather has died and can't teach you what he learned or great grandmother has learned, then now that knowledge is gone and we repeat. And if you look back through cycles of history, you can see almost every 90 years, we do the exact same things. It's crazy. You can really see it through major disasters, major wars, major things. And it's an interesting thing, but we don't have to look back that far, and we could talk about,
right.
So in the 60s and 70s, there were the untouchable stocks, the stocks that could never go down. It didn't matter how much you paid for them. It was called the Nifty 50. These are good companies like McDonald's and Texas Instruments, right? Sears and Roebuck. Now, some of these companies, Kodak, have gone bankrupt since then. But these were companies that did not matter what you paid for them. They could never come down. Does that sound familiar? Maybe something like FANG stocks. Like they earn so much money. They earn so much money, they can never come down. Well, people were paying 50 times earnings for these consistently, 50 times earnings, because these stocks were amazing and they can't come down. How could these stocks come down? They earn so much money. These are such great stocks. Well, guess what happened? Not only did they have a huge crash in the 80s, but then, or at the end of the early 70s, but then it took 10 years before they got back to even.
Yeah.
This shows you that there is too high of a price to pay, and that history does repeat itself, because I hear these same things for the FANGs. How could these stocks ever come down? Now, you look at Facebook, and at its bottom, it had lost 75% of its market cap. It went from $1 trillion to 200 and some billion dollars.
Yeah.
Right? Is that insane? So you do see that history repeats itself, and there is too expensive to pay, even if the company is earning a lot of money. And this is without talking about GDP. This is without talking about what earnings will do going forwards, because there's multiple ways a PE can change, right?
Right.
There's the price part and there's the earning part, and you need both of them to correspond properly for it to be a good deal.
The P and E is like the I and the G, Daniel. Right? TR equals I plus G, right? And so that's a very important thing. If you want your retirement to be stress-free, invest for the I rather than the G. We'd love to give you away this book, Financial Insanity by our friend David Scranton, with a lot of alphabet soup after his name. Easy read book to be able to help educate you to be able to understand how there's insanity in the financial markets right now. You can have your free copy by being one of the first 5 first-time callers at 800-725-7616. 800-725-7616 for your free, no obligation book. Call now.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
There's a phenomenon that takes place, and it's really a crazy thing, Daniel. You see it happening. It's most easily viewed, I think, or one of the most easily ways that it's viewed is when elections. Not trying to get political here, but political elections, and choose whatever party you want. But elections occur, and there's a bad there's a person that's elected that is not going to work in the people's best interests, and people cry out and have a difficulty with that. And and then as time goes on, they kind of get used to that. And then at election time, when it's time that they could vote that person out, they do the exact same thing and vote in the same way because they forget about history. They forget the pain that's going on. And that, unfortunately, is one of the reasons why history tends to repeat itself more often than not. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about buying stocks high and selling them even higher. That's something that does. We got short memories, right? People have
Right.
short memories, and sometimes when there's a lot of pain, we cover that over and then kind of forget about it. And sometimes we need to keep that to remember, right? Remember
Keep
what's
you
happened.
sharp. That's
Yeah.
right. That's right. Remember the trade towers, right? And what went on with that. And you were talking earlier about history repeating itself. And one of the examples are with war, right? That the generation, about the time one generation forgets the mistakes of the other generation, they make the same mistakes. So with Vietnam, the thing was it was said we will never enter another war without an exit strategy, the way we had with Vietnam, and then we entered the war on terror and had it for decades without an exit strategy. Craziness. Why does history repeat itself? Because people are the same from generation to generation. That's the one thing throughout history that doesn't change. Technology changes, everything, money changes, everything changes around us. People change, positions change, everything changes except people don't change. And that's the emotions that we were talking about earlier with the idea of how people forget. And right now you ask people about what happened to them in 2008, 2009, and they'll say something like, "Oh, I lost money like everybody else. No big deal." But at the time, it was a huge deal. And they didn't know what was going to happen. And not everybody else lost money is the problem, right? People that followed, well, we won't go there, but people that bought high to sell higher, they lost money. And that's what we're trying to help people to be able to recognize and protect themselves from that standpoint.
Yeah, we talked about passive flows, right? And why would people, when every metric you look at, markets are, U.S. stock markets are high, why would people stay in? And why would people continue to invest at these ridiculous valuations? We hear people say all the time stuff like, well, we need to be aggressive. We think the economy is going to be booming. And indexing has worked pretty well for the last 13 years. But it has to do with these passive flows we talked about. Now we talked that 401ks, because good markets attract more money, international money has come to the US. And then the thing we haven't talked about is there hasn't been alternatives in a deep way. So like, let's say the central bank of Switzerland, for example, was buying US stocks. How crazy is that, right?
Yeah.
But they're buying stocks because what are they going to do? They're going to buy gold. They have gold. They're going to buy U.S. Treasuries. Well, they weren't paying anything, so there was no alternative. Well, now there's some alternatives. When you can earn 5% on a 1-year U.S. Treasury,
Mm-hmm. Mm-hmm. Right.
or averaged over a long periods of time, 7%
Yeah.
on stocks that, going through cycles, but you're buying it at the high now.
Yeah.
What sounds like a better risk return? Now, there's things that will pay you more than a 5% US Treasury. This is just the risk free rate. So everything adjusts to
Yeah.
this new risk free rate of
Mm-hmm.
5%. So you have to earn a spread that's suitable to you, that's desirable to you above that 5%. Is buying, right? So we talked about the Nifty 50 crashing 65%. So if we compare that to markets today and you say that there is a 65, you could have a 65% downside. What upside do you need above that 5%? Do you need to take on the risk of the potential? I'm not saying it will. I don't think it will go down that much, but it has happened in the past to take on that risk that you have a
Yeah.
potential of losing 65% of your money.
And that's the spread. That's the risk. That's the risk premium that you have to determine is worth it. And I like what you talked about earlier. Well, off the air, where you're talking about how you bought those bonds at 6.5%. The market has averaged 7% over the past 20 years, and you bought bonds at 6.5. I mean, that's crazy. Yeah, because the safety of the bond that you bought is far lower, much lower than what was taken on at that 7% risk for that stock market. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know. What people don't know, today's topic is buy high, sell higher. It's not really what we're advocating, but that's what people are doing today. And we have a paper that we'd love to put in your hand that be able to help you to be able to plan ahead and to be able to prepare yourself for this. And this paper is called How Much Do I Need to Retire? Well, this paper is going to be able to help you understand what you need to retire, how to calculate that, and how to get the money. A lot of people think that, what you need to retire is 1 million, 2 million, whatever the number is, a lump sum. And you don't need that, because you're not going to spend that money when you retire. You're not going to retire and go spend 1 million or 2 million. You need an income off of that check. And that's the key. More than the bottom line is what's the yield that's going to produce. So we'd love to put this paper in your hand, and you can call us 800-725-7616 for your free copy. How much do I need to retire on? Call now, 800-725-7616. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is buy high, sell higher. Daniel, that when we're, the adages are buy high. The whole thing is buy low, sell high. But then what people end up doing is buying high and selling low. And that's what we're trying to keep people from doing right now, isn't it? When we say buy high, sell higher, that's what they're thinking they're going to do, but that's not always the case. And we've talked about how people have short memories. In 2000, the market dropped 50%. It took 7 years for the market just to get back to where it was. In 2007, the market dropped 60%. It took 5 years for the market just to get back where it was. In December of 2018, the market dropped 25% in like that 1 month. It didn't take long for it to come back, but it came back, it kept going. So people don't think about that. Then COVID, it dropped 40%. Again, it didn't take long to come back, but now it's dropped 15, 20%, and it's not back yet. You talked about earlier, well, let me say this, is that there's pressure. I see that there's pressure on the market right now to keep itself lower, right? There's more pressure on the market to drive it down or flat than it is to go up. Am I correct?
Right. Well, that's where we can look at historical metrics, right, for judging, for pricing the markets. And there's a lot of different indicators that we could use in order to see if stocks are fairly priced, if stocks are expensive, or if stocks are a good value or cheap. And of
Right.
course, you want to buy one cheap. Now, we get in our way a lot of times. Humans get in their way a lot of times. I was pushing people to buy Tesla as hard as I could. when it was priced for bankruptcy, because it made no sense how cheap it was. They weren't going bankrupt, and Google and Apple wanted to buy them. Apple had already made an offer to buy them. So I said, worst case scenario, Apple will buy them. So like they had convertible bonds. These look like an amazing deal because they go bankrupt. Apple buys them, takes on the debt. You get your money back plus whatever interest you collect. If this autonomous stuff, if this new Model 3 they were building, if these kinds of things happened, the stock could go insanely high. And we took advantage of that. People said, no, 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 no. What did you put that in my account for? This is dead money. We don't want this, right? 22x later, 22 times their money later, we're looking at it and we say, this is too expensive. This is ridiculous. We don't want this. Why other people are hopping on board because they're like, look, this has gone. So this is the trade-offs we're talking about, right? Right? Just because something's been going up for a long time does not mean, and now Tesla's come down and it will find its place. Who knows if it will go up higher or come down? It still seems expensive, but it's hard to value, right?
Yes,
we're not talking about that. We're talking about a historical pattern of when you can see something's cheap. That's when you need to get in it. The problem is people are scared of that.
Right.
They're scared when it's cheap because they don't see the upside and they want to get in when it's expensive. And that's why I hate when people say, well, we need to be aggressive, because they mean let's buy something that's been going up for the last 25 years. Let's buy Apple at these ridiculous numbers. It's growing at 1% a year, but it's got a 40 times PE or whatever it is. How does that make sense?
It
right?
doesn't.
It doesn't. It doesn't. You have a lot of downside, but not upside. So we're not advocating that stocks are bad, and we're not doomsdayers. But what we're trying to do is say when something's high, you need to say acknowledge that it's high.
That's enough.
Unless you're going to say, well, I think Apple's going to be a good investment over the next 30 years. So I would just be holding it for 30 years because I think that nobody does that because we don't think that far out. So in 10 years, if it hasn't done anything, you're going to hop out of that and you're going to try to buy the next thing. And it may work and it may not. But what we're advocating for is looking at these things and their historical numbers and saying, this is either high, I need to look at other opportunities, especially if you're in retirement. If you're in or close to retirement, can you afford to have zero growth for the next 10 years?
Right.
Is your portfolio that big that you can get zero growth for 10 years and still support the lifestyle that you want to have? Is your portfolio big enough that you can stomach a 40% correction and then slowly over the next 10 years come back to even? Is your portfolio that big that you can handle that? Because if the answer is no, then you need to start doing some value. This is a good time to evaluate that because there's a lot of opportunities where you can switch to the kind of things that we talk about where you get paid. And maybe in the next segment, we can talk, kind of about these valuations, but I'll let you.
Exactly. That's exactly right, Daniel. We're going to need to take a break, but I want to, in the next segment, I want to talk about the three options that are out there that we're seeing in regard to the potential of the stock market going into the next 5 to 10 years. So, I hope you come back. If you're just picked up listening to us, you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is buy high, sell higher, and come back and hear the rest of the story in our next segment. But in the meantime, call for your free book at 800-725-7616. We're giving away the book Financial Insanity, because what's going on out there in the market and in the world right now is really a lot of insanity, financially speaking. So we'd love to put this in your hand for free. It's an out-of-print book that we have still some copies available for you. Call now. First-time callers at 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
My brother Dan has, got into computers early on. They're in the 60s, and was in IT all his career, and is now retired and enjoying not being in technology today. He says he doesn't want anything to do with technology today because how far it has come, which is really interesting. But one of the things that he always used to say back when computer, the personal computer was new in the 80s and such, and I was trying to wrap my head around it, was that computers don't make mistakes. The people that program computers make mistakes. It's kind of like, guns don't kill people, it's people kill people, right? So the idea here is that there's an old computer term called GIGO, garbage in, garbage out. If whatever you put into the computer, you put garbage into the computer, you're going to get garbage out of the computer, right? It's like your body, right, Daniel? You like to put good stuff in your body so you get good performance out of your body. It's the same principle. It's one of those principles of life and laws of nature kind of thing. You put good stuff in, you get good stuff out. You put bad stuff in, you get bad stuff out. And that's, I think, comes in today when we're talking about today's show is buy high, sell higher. Well, I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about buying high and selling higher. And is that a good strategy for a retirement portfolio?
No.
I love that. I love that giggle, garbage in, garbage out, or what you put into it. Like the computer's not going to make the mistake. It's what information you have, and that makes me think about the PE, the price per earnings, right? Because you got these little analysts that decide that they decide what they think that the company is going to earn, right? Yeah. And so they can say, well, we think that this company is going to earn X and the price is this. So that gives us a price to earnings of this. Now there's a couple ways that PE can change, right? The price can go up or down, which makes it cheaper or more expensive if the earnings haven't changed. The multiple could change. So you could say, well, this company, we think they're going to have a good future. It deserves more of a multiple. So instead of us saying that 8 is a good price, 8 times earnings, 28 is now a good multiple. So that can allow the price to go up.
Right.
Now, the other thing that can happen is the earnings can change, right? Mm-hmm. Mm-hmm. So if you say, we think this company is going to earn $100 billion this year, but they only earn 50, that changes the PE tremendously. So if these analysts whose job is to compute this stuff or to gather the information and put it into a compute machine, get that earnings wrong or their predictions of the earnings wrong, this can create all kinds of havoc because if the earnings change, that could make that PE, that price for earning that you thought was a good deal, that could make that outrageously expensive really quick. And if it's outrageously expensive really quick, though, all investors decide this company deserves a 15 times earnings, and now the earnings go down. What does that mean has to happen to the price?
Right.
The price has to come down as well.
Right.
So some of the things we look at, right? When we say stocks are expensive by all kinds of metrics, one is the yield curve. And the yield curve is undefeated in predicting recessions, right? And it's somewhere around 18 months from when, it depends what yield curve you use. But if it's something like the twos fives or the fives tens or the twos tens, when those invert, and invert means the longer dated bonds are paying you less, or a longer dated CD, longer rates are paying you less than shorter date. Somehow this knows when there's going to be a recession. What happens when there's a recession? Well, when there's a recession, earnings come down. We can look at credit card spending, right? Everyone says how great the economy. We can look at credit card spending and we can see that credit card spending is going up, 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 up. That means people are buying their goods and services, which is what creates GDP, gross domestic product, goods and services. We can see that that's being on credit card spending, right?
Right.
So when credit card limits run out, if wages haven't gone up, then spending has to come down. When spending comes down, that brings GDP down, right?
Right.
When we look at something called the Warren Buffett indicator, it looks at 5,000 U.S. stocks, right? And it compares that to GDP. So if we look at GDP currently, and we divide that by the price of the stocks, we can look at historical rates of where stocks were expensive and where they were cheap. And so if we look at like the 2000 tech bubble, and we say that that peak was 2 standard deviations above the norm, right?
Yeah. Yeah.
And norms or percentages or averages can fool us, right?
Yeah.
Because we
Yeah.
think in Excel everything just goes straight across, but in real life we go way under the norm and then we go way above, and we correct. We don't go flat. We go way up and way down. That's when people say stock markets average 7%. Well, it's not 7% every year. It's way down, way up, way down, way up, right? And if you need
Right.
your money in those periods of times, then you could be in trouble.
Right. Right.
So this market in 2000 was 2 standard deviations above the normal. And in 2000, when it corrected, it came down close to 1 standard deviation below the trend.
Mm.
In the 2008, 2007 financial bubble,
Yeah.
we didn't even get to 1 standard deviation
Oh,
above
no.
the
Wow.
norm. And we came down well beyond, about a standard deviation and a half below that.
Wow.
The 2001 run up, we went up as high as 2 standard deviations above the norm. So the tech bubble was 2 standard deviations. That 2001 run up about 2 standard deviations. We corrected down, and right now we're about 1 standard deviation above the norm on
Oh,
this
no.
indicator.
And that's like 10 times, I think is what you were saying to me. It's still very high. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is buy high or sell higher. Well, that's what we're trying to tell you, that it's not the case. And we've got some things coming up as we finish off the show. But in the meantime, we want to let you know where we have a paper that we'd love to put in your hand. How much do I need to retire? This paper is helping you to understand when you're talking about retirement, you have to look at things differently than you had when you had the 401k brain, putting up and building up your 401k. Retirement's not based upon your bottom line assets. It's based upon what your earnings, what your income can be from those assets. So it's important that you don't lose assets. It's important that you don't buy high to thinking that you're going to sell and hoping that you're going to sell higher. So we'd love to put this paper in your hand. How much do I need to retire? You can have it by calling 800-725-7616. You're listening to Agemy. This Daniel and Andrew Agemy, Financial Strategies, because people don't know what people don't know. So, Daniel, you had said the options going forward in regard to things here is that, as far as, we talked earlier about history repeating itself, and that we're viewing that basically there's 3 options that can happen going forward. One is a 60% crash in the market, but the possibility of that happening, it's possible, but we're not certain about that. The second thing is
to bring all these metrics back to a reasonable level, right? If markets crash 60%, that would bring us right back kind of to that norm.
To that standard deviation you were talking about, the trend that you were talking about. Am I correct on that? Okay.
Yeah.
And so another option is that the GDP could increase with massive amounts, but the likelihood of
we could grow our way out of it. Yeah, absolutely.
Right. But that's like buying size 10 pants for your 2-year-old. It's going to take him a long time to grow into those 10 pants, right? He's going to have to be on steroids or eating a whole lot of food to be able to grow into those size 10 pants, right? So that, the likelihood that's not good, because number one, the interest rates are high right now, which 40% of the national budget is going toward the interest. Which, how do you get out of debt if 40% of all the budget is going, is paying for interest? And then okay, so let's just say interest rates went to zero again, and we don't have that interest rate risk at that point. Well, now the debt is so high anyway, and it's compounding because they're spending more, they're printing more money, and they're not paying all the interest on the money, so it's compounding. So now just the debt itself is keeping us from growing in that fashion. And then, so the third thing, which seems to be the most likely, right, is that the market stays flat for the next 5 to 10 years. And people may not remember what happened in 2014, October 2014 to November 2016. The market basically was flat. Sure, it went up and down a little bit, but it didn't earn anything for the 2-year period of time. And people don't remember that. And if they were invested for growth, if they were invested it to buy high and sell higher, they weren't going to do it during that time. But if they were invested for the earnings, if they were invested for the income, for the dividends, the interest, if they were invested in 6.5% bonds, they would have made good money. In the bonds case, they would have made 6.5% per year. They would have made 13% total over that 2-year period. But people don't know what people don't know.
Yeah, exactly. I agree with you. I think that that's the most likely output, or maybe it's a mix between some stimulus, some government stimulus, which will not boost the economy by much because there's a whole ratio about how much debt you have to spending, and you need more and more dollars of spending to get there. But maybe there's some stimulus, and then there is markets come down, and maybe we're flat for 5 to 10 years while we try to grow our way out of this hole. But that's kind of what we're looking at. What I'm looking at right now is markets kind of flat, choppy for the next 5 to 10 years. And the passive that has worked well for people for the last 10 years will far underperform kind of these international equities that are paying nice dividends, that are cheap, that are up and coming, or income investments that are paying you, even if you have money parked in 5-year treasury or 1, 2, 3-year treasury bonds earning somewhere around 4 to 5%, and having that available for buying opportunities. These are the kinds of things that I think will serve especially retirees really well. I mean, you need income. You don't, that's what that paper we're giving away is about. How much, like, what do you need to retire? Well, how much do you need to live off of? Right. And how do you get there? You don't need the growth necessarily. You don't need to make 30% in a year if you have these huge downside potentials. And what's the likelihood of 30% upside anyways?
Very good. Not very good. If you want
not in U.S. stocks.
Now if you want your retirement to be stress-free, you got to invest for the I and not the G. You got to invest for the income rather than the growth. You listen to Financial Strategies with Andrew and Daniel Agemy. It's not about the investments and such. It's about the strategies that you use. And today's topic is buy high, sell higher. Not the way that, not unless you want to hope that you retire, and hope is not a retirement plan. We have a book that's going to be able to help you to understand how you can do things differently than the stock market way, than the buying the high and trying to sell higher. Well, how you can depend upon and get dependable retirement income. Financial Insanity, yours for free by calling us at 800-725-7616. The first 5 callers, first 5 first-time callers at 800-725-7616. We appreciate you joining us today. We wish you the best, but if you want your retirement to be stress-free, invest for the I and not the G.